A lot of people want to buy a rental property, but they get stuck on one question. What credit score do I actually need? Is it 580, 620, 680, 720? Or do you need perfect credit to buy an investment property? The answer is not as simple as one number. Because the credit score you need depends on the type of loan, the lender, your down payment, your income, your debt, your reserves, and whether you are buying the property as a true rental or living in part of the property yourself. In this video, I'm going to break it down in a simple way. We'll talk about the minimum credit score, the better target credit score, and the score that usually gives you stronger options as a rental property buyer. By the end of this video, you'll understand what credit score range you should aim for before buying your first rental property. And more importantly, you'll understand why the minimum score is not always the score you should aim for. Let's get into it. Here is the simple answer. If you are buying a rental property with a conventional investment property loan, many lenders are going to want to see at least around a 620 credit score. But that does not mean 620 is ideal. It just means that may be the minimum starting point. For rental properties, a stronger target is usually 680 or higher. And if you want better loan options, better pricing, and a smoother approval process, you may want to aim for 700 to 740 or higher. Now, this does not mean everyone below 700 is automatically rejected. It also does not mean everyone above 740 is automatically approved. Your credit score is only one part of the loan approval. Lenders also look at your income, debt-to-income ratio, down payment, cash reserves, employment history, property type, and the strength of the deal. But when you are buying a rental property, credit score matters a lot because lenders usually see investment properties as riskier than primary homes. Why? Because if someone runs into financial trouble, they are more likely to keep paying the mortgage on the home they live in before they keep paying the mortgage on a rental property. That means lenders often want stronger qualifications for rental properties. So the simple answer is, you may be able to start around 620, but you probably want to aim for 680 or better. And 700 to 740 plus can put you in a stronger position. Buying a rental property is different from buying a home you plan to live in. When you buy your personal home, the lender is looking at it as your primary residence. But when you buy a rental property, the lender knows the property is being purchased to make money. That changes the risk. Investment properties often require higher down payments, stronger credit, more reserves, and sometimes higher interest rates. This is why someone may qualify for a primary home loan but struggle to qualify for a rental property loan. For example, a person might be able to buy a primary residence with a lower down payment. But for a non-owner occupied rental property, the lender may want 15%, 20%, or even 25% down depending on the loan program, property type, and borrower profile. And when the lender sees more risk, they usually want more protection. That protection can come from a bigger down payment, a higher credit score, more cash reserves, lower debt, or stronger income. So when people ask, what credit score do I need to buy a rental property? The real question is, how strong does my overall file need to be? Because a credit score alone does not get you approved. It helps open the door. But the rest of your financial picture still has to make sense. Let's talk about the 620 credit score level. For many conventional loans, 620 is often viewed as a minimum starting point. But here is the problem. A 620 score may get your application looked at, but it may not give you the best terms. And for a rental property, the lender may still want other parts of the file to be very strong. That could mean a larger down payment, more money in reserves, lower debt-to-income ratio, strong employment history, and a property that makes sense as a rental. At 620, you may have fewer lender options. You may face a higher interest rate. Your monthly payment may be higher, and the deal may not cash flow as well. This is important because a higher interest rate can completely change the numbers on a rental property. Let's say a property looks like it will cash flow at one interest rate. But if your credit score causes the rate to be higher, your monthly payment goes up. That can turn a decent deal into a weak deal. So yes, 620 may be possible in some cases. But if you are serious about buying rental property, you should probably not treat 620 as the goal. Think of it as the minimum doorway, not the destination. Now let's talk about 680. For many rental property buyers, 680 is a better target. At this level, your credit file may look stronger to lenders. You may have more loan options. You may have better pricing than someone barely meeting the minimum. And your approval may be smoother if the rest of your finances are solid. This does not mean 680 guarantees approval. It does not. But it can put you in a more realistic position. If you are planning to buy your first rental property and your score is currently in the low 600s, aiming for 680 before applying may be a smart move. That could give you time to pay down credit card balances, clean up late payments if possible, avoid new debt, and strengthen your file. Remember, rental property investing is not just about getting approved. It is about buying a property that actually works financially. If a better credit score helps you get a better loan, that can improve your cash flow. And cash flow matters. Because when the property needs repairs, sits vacant, or expenses increase, you need room in the numbers. A better credit score can help create that room. Now let's talk about 700 to 740 and above. This is where you may start looking much stronger as a borrower. Again, every lender is different, and credit score is not the only factor. But a higher credit score can help you qualify for better loan pricing and more options. When you are buying a rental property, this can make a big difference. A lower interest rate can mean a lower monthly payment. A lower monthly payment can mean stronger cash flow. And stronger cash flow can make the investment safer. For example, imagine two investors buying the same property. Investor 1 has a 625 credit score. Investor 2 has a 740 credit score. They both want to buy the same $250,000 rental property. Even if both investors get approved, they may not get the same interest rate, the same fees, or the same terms. The investor with the stronger credit profile may have a lower payment. That lower payment could be the difference between positive cash flow and negative cash flow. So if you are not in a rush, improving your credit before buying can be worth it. Sometimes the best move is not buying immediately. Sometimes the best move is spending a few months getting your credit score, cash reserves, and debt situation in better shape. Because when you buy a rental property, the loan is part of the investment. Bad financing can ruin a good property. Here is something many beginners miss. Your credit score matters, but it is not the only thing lenders care about. A lender may also look at your debt-to-income ratio. That means how much monthly debt you have compared to your monthly income. They may look at your employment history. They may look at your down payment. They may look at your cash reserves. They may look at the property itself. They may look at whether the rent is realistic. They may look at your experience as an investor. They may also look at how many financed properties you already own. So you could have a good credit score and still have trouble getting approved if your debt is too high, or if you do not have enough money saved, or if the property does not support the loan. On the other hand, someone with a lower credit score may still have a chance if they have strong income, a big down payment, low debt, and solid reserves. That is why you should not only focus on the score. The better question is, how strong is my full financial file? Because lenders are not just asking, what is your credit score? They are asking, can this person handle the payment? Can this person handle repairs? Can this person handle vacancy? Can this person handle the risk of owning a rental property? That is the bigger picture. Now we need to talk about something very important. There is a big difference between buying a pure rental property and buying a property you live in while renting out part of it. A pure rental property is non-owner occupied. That means you do not live there. You are buying it strictly as an investment. This usually comes with stricter loan requirements. But if you buy a small multifamily property and live in one of the units, that may be considered owner-occupied. For example, You buy a duplex. You live in one unit. You rent out the other unit. This is often called house hacking. In that situation, you may have access to loan programs that are not available for pure rental properties. For example, FHA loans are generally designed for owner-occupied properties. That means FHA may be an option if you are living in the property, but not if you are buying a property purely as a rental and never plan to live there. This is a major distinction. Some beginners say, "Can I use FHA to buy a rental property?" The better answer is, you may be able to use FHA to buy an owner-occupied property where you rent out extra units if you meet the rules. But FHA is generally not for buying a non-owner-occupied investment property. So when someone says you can buy with a lower credit score, make sure you understand what type of purchase they are talking about. Are they talking about a primary residence? An owner-occupied duplex? A house hack? Or a true rental property? Those are not all the same thing. Let's talk about FHA for a minute because it confuses a lot of people. FHA loans are known for being more flexible with credit compared to many conventional loans. In general, FHA allows borrowers with a 580 credit score to qualify for the low down payment option, and borrowers with scores from 500 to 579 may need a larger down payment. But again, this is generally for owner-occupied properties, not a pure rental property. So if your credit score is lower and your goal is to become a rental property owner, house hacking may be one possible path. You could potentially buy a duplex, triplex, or 4-unit property, live in one unit, and rent out the others. This can help you get started in real estate while using a loan designed for owner-occupants. But you must follow the rules. Do not pretend you are going to live in a property if you are not. That is mortgage fraud. You need to be honest with your lender about your plans. So the key lesson is this: lower credit score loan options may exist for owner-occupied purchases. But if you are buying a true rental property that you will not live in, expect stricter requirements. Now let's connect credit score to cash flow. A rental property is a numbers game. Your rent comes in. Your expenses go out. Whatever is left over is cash flow. But your loan payment is usually one of the biggest expenses. So if your credit score affects your interest rate, it can also affect your cash flow. Let's keep it simple. If a higher credit score helps you get a lower interest rate, your mortgage payment may be lower. If your mortgage payment is lower, your cash flow may be stronger. If your cash flow is stronger, the property may be safer to own. This is why credit matters so much in rental property investing. It is not just about approval. It is about the quality of the deal after approval. A beginner may think, "I just need to get approved." But an investor should think, does the financing allow this property to make money? Those are two different questions. Getting approved for a bad deal does not help you. You want the property to work after the mortgage, taxes, insurance, repairs, vacancy, management, and other expenses. So before you buy, run the numbers with realistic financing. Do not assume the best possible interest rate if your credit score is not strong enough to get it. So what should you do if your credit score is too low right now? First, do not panic. A low score today does not mean you can never buy a rental property. It just means you may need to prepare first. Start by checking your credit reports. Look for errors. Look for late payments. Look for high credit card balances. Look for collections. Look for anything that may be hurting your score. One of the fastest areas to focus on is credit card utilization. That means how much of your available credit you are using. If your credit cards are close to maxed out, that can hurt your score. Paying down revolving balances may help improve your credit profile. Second, avoid taking on new debt before applying for a mortgage. Do not finance a car right before trying to buy a rental property. Do not open unnecessary new credit accounts. Do not run up credit cards. Third, make every payment on time. Payment history is a major part of your credit profile. Late payments can damage your score and make lenders nervous. Fourth, build cash reserves. Even if your score improves, Lenders may still want to see that you have money left after closing. Rental properties need reserves because repairs and vacancies happen. Fifth, talk to a lender early. Do not wait until you find a property. A good lender can tell you where you stand, what score range you should target, and what loan options may fit your situation. The goal is not just to buy fast. The goal is to buy prepared. So what credit score should you actually aim for? Here is a simple way to think about it. If your score is below 620, you may have limited options for a conventional rental property loan. If your score is around 620 to 679, you may be able to start the conversation, but the deal may be harder and the terms may not be ideal. If your score is 680 or higher, you may be in a better position. If your score is 700 to 740 or higher, you may have stronger options and potentially better pricing. But do not focus only on the score. Also focus on saving a strong down payment, lowering your debt, building reserves, keeping your income stable, avoiding new debt before applying, and learning how to analyze rental property numbers. Because even with a great credit score, you still need to buy the right property. A great credit score does not fix a bad deal, and a bad deal can still lose money even with good financing. So your goal should be to become a strong borrower and a smart investor. That combination gives you the best chance. Let's recap. What credit score do you actually need to buy a rental property? For many conventional rental property loans, around 620 may be a minimum starting point. But 620 is not necessarily a great target. A better target may be 680 or higher. And if you can get into the 700 to 740 plus range, you may have stronger options. But remember, credit score is only one part of the approval. Lenders also look at your income, debt, down payment, reserves, property type, and overall risk. If you are buying a true rental property that you will not live in, expect stricter requirements. If you are buying an owner-occupied multi-family property and living in one unit, you may have different loan options. And if your credit score is not where it needs to be yet, do not give up. Use that time to pay down debt, improve your payment history, build reserves, and get your finances ready. The goal is not just to qualify for a loan. The goal is to buy a rental property that actually makes financial sense. Because the best investors do not just ask, "Can I buy this property?" They ask, "Should I buy this property? And does it still work after the real numbers are included?" If this video helped you understand rental property credit scores, subscribe for more simple videos about money, credit, and real estate. In future videos, we'll cover how to analyze rental properties, how to improve your credit before applying for a mortgage, and how to avoid buying deals that look good on paper but lose money in real life. And remember, your credit score matters. But your full financial picture matters even more. Build your credit. Save your cash. Run the numbers. And never buy a rental property just because you got approved. Before you go, if you're interested in buying rental properties, improving your credit, understanding money, and learning how real estate investing really works, make sure you subscribe. This channel is all about breaking down money, credit, and real estate in a simple way without making it confusing. I'll be posting more videos on how to analyze rental properties, how to build better credit, how to avoid bad deals, and how to make smarter financial decisions. So, if you want simple, practical information that can help you move closer to buying your first rental property, hit the subscribe button. And remember, better credit gives you more options. Better numbers help you make better decisions. And the more you learn before you buy, the better prepared you'll be when the right deal comes along.